10 ways to finance a business. Every year, thousands of people start companies. While their businesses may be different, all of these people have one thing in common. They all had to find ways to raise money to finance their company, to get the business off the ground, and to cover corporate expenses. Finding financing in any economic climate can be challenging, whether you're looking for startup funds, capital to expand, or money to hold on through tough times. But given our current state of affairs, securing funds is as tough as ever. Regardless of the industry, raising capital through financing solutions consists of either debt, equity, or a hybrid combination of both. Keep in mind that there are no good or bad solutions. The best solution for you depends on your specific circumstances and requirements. When launching a business, the main components to ensure your success are the quality of your ideas and your willingness to put in the work required to see those ideas come to life. There are two ways to externally fund a business: debt and equity. When debt is used, the investor receives a note for his or her cash. The note spells out the terms of repayment, including timing and interest. The benefit of using debt is that you retain ownership of your company. The downside is that you have an obligation to repay. If you fail to meet your commitment, the lender, under certain circumstances, can force the company into liquidation. Then there's equity. An owner who uses equity to fund a business turns over an ownership stake to an investor in return for the latter's cash. The benefit is that there is no obligation to repay the investor. The downside is the owner has to give up a part of the ownership of his or her business. This can entail losing some control over the company. Dear future entrepreneurs and moguls, here are 10 ways to finance a business. Number 1. Get a bank loan. In a loan, the bank gives you a set amount of money that is repaid over a period of years. A line of credit provides a revolving facility that can be used when needed and paid back on a regular basis, much like a credit card. Getting a loan or a business line of credit can be difficult. The bank's main interest is in getting paid back, and their preferred way of getting paid is through the cash flow that your business already generates. As a result, they will only provide financing if your company has a proven track record of generating cash and has substantial assets. Number 2, your funds. Probably one of the quickest and easiest way to fund a business using your own money can limit the amount of hassle that growing your own capital will normally bring. Ideally, before starting any business, you should save money for some time and use it to fund your business. This is probably the wisest, most conservative, and safest way to start a company. However, an obvious problem with this type of financing is that you are limited by the amount of money you can save. Saving to start or operate a business is a great idea. However, you shouldn't use retirement savings, home loans, insurance loans, and similar sources to finance risky business ventures. You should consider speaking to a qualified financial advisor if you plan to do so. Number 3. Use factoring. This type of financing has become very popular and is now used by small businesses or entrepreneurs across the country. Factoring can provide a reliable source of funding if your company has cash flow problems due to slow incoming invoices from your customers. However, you can only use factoring if you work with commercial and government clients with good credit. When used correctly, the line can improve your cash flow and enable you to take on new clients. More commonly, it is often used by companies with poor credit or by businesses such as apparel manufacturers, which have to fill orders long before they get paid. The only downside to factoring is that it can be quite an expensive way to raise funds. Number 4. Friends and family. Many entrepreneurs fund their small businesses by getting friends and family to invest in them. You can ask your friends and family to make an equity investment, in effect, selling them a part of your company, or you can ask them for a business loan. There are 2 problems with using friends and family as a source of business financing. The first one is that if the business fails, you risk affecting the relationship. The second problem is that you will most likely gain a new business partner even if you don't want one. Once their money is at stake, even so-called silent partners can become very talkative and opinionated. Asking friends and family to make an equity investment can be a good way to finance your company if you are very careful. Be sure to get the agreement in writing and have a lawyer drafted for you. Also, you should spend a lot of time educating your investors about the risks of your business. Lastly, you should consider reminding them to only invest money they can afford to lose. Number 5. Try crowdfunding. Crowdfunding is a way for people, businesses, and charities to raise money. It works through individuals or organizations who invest in or donate to crowdfunding projects in return for a potential profit or reward. A good example of crowdfunding site is Kickstarter.com. It is pretty popular and can be a fun and effective way to raise money for a creative project or a business. You can set a goal for how much money you would like to raise over a certain period of time, say $1,500 over 40 days. Your friends, family, and strangers can then use the site to pledge money. Always keep in mind that crowdfunding isn't about long-term funding. Rather, it is to be used to facilitate the asking for and giving of support for single one-off ideas. Number 6. Using investors. Angel investors are successful business people who dig into their deep pockets to finance new businesses with high growth potential. If you're low on startup capital, an investor can be seen as a blessing from God. However, before accepting an offer from any investors, you must carefully read the fine print of the loan or agreement. All money from a potential investors is not a loan. It is typically an equity investment. In other words, it is a way by which the investor acquires a share in the ownership of the company. Therefore, by you accepting money from an investor, you are also giving up partial control of your new business. An angel investor will generally ask for at least a 10% stake in your business, but could go as high as 50% for a riskier startup. Number 7. Using Action. Action is one of the largest microfinance and small business lending networks in the country with offices in every state. To an extent, they are similar to an SBA microloan. They provide startup financing and they also fund ongoing concerns. To be eligible for general financing, you need to have been in business for 6 months and you must have sufficient cash flow to repay the debt, among other requirements. Action also offers startup loans of up to $10,000. Action offers small business loans for a variety of purposes. However, Action is structured so that your specific location and state dictates which loan you have access to and which you don't. The one constant is Action's willingness to lend to businesses of many sizes, including startups. Most loans only require a credit score of 575, and there is no requirement for how long you've been in business. Number 8. Using an SBA loan. With establishments being hesitant to approve people for loans amidst the credit crisis, loans that are guaranteed by the U.S. Small Business Administration have become the go-to. The SBA has a little-known but extremely helpful microloan program that provide business loans for up to $50,000 to small businesses and young entrepreneurs. They don't provide loans directly. Instead, they use intermediaries to fund the loans. Many of these intermediaries also provide management assistance and may require training as a condition for a loan. The advantage of this program is that their training and assistance often increase your chances of success. Number 9. Using credit cards. Depending on your level of education and your know-how, credit cards can help you achieve your financial goals or lead you into a financial pit. Credit cards can be an effective way to finance your business and to extend your cash flow in numerous ways. You can use them to pay suppliers and often earn discounts, certain protections, or other rewards. The dangerous side of credit cards is that it is directly tied to your credit score and they carry very high interest rates. Therefore, misusing them will be to your detriment. Number 10. Try social lending. Social lending websites allow people to apply for loans from other people. Generally, the two parties set their terms and the website acts as the intermediary. If not all, most loans on lending sites are 3-year unsecured loans, meaning that the loan is usually made without any collateral. Once the loan has been approved, the amount is deposited directly into the borrower's account. Likewise, fixed monthly payments are automatically deducted from your bank account for the life of the loan. One great example of a social lending site is prosper.com. You can register as a borrower and post a loan request for a fixed amount of money at a maximum interest rate. Interested lenders will then bid on your loan. When you find a lender that offers an attractive interest rate, you proceed with the loan. In conclusion, finding financing in any economic climate can be challenging. Whether you're looking for startup funds, capital to expand, or money to hold on through the tough times. But given our current state of affairs, securing funds is as tough as ever. Regardless of the industry, raising capital through financing solutions consists of either debt, equity, or a hybrid combination of both. Keep in mind that there are no good or bad solutions. The best solution for you depends on your specific circumstances and requirements. The end. Thank you.